Hey, good afternoon. Happy Friday, June 14th. Mark Milam here, your mortgage professional. Let's get right to it. Very pivotal week for mortgage interest rates and really the economy at large. And the reason being is we got a lot of data this week, particularly on Wednesday and Thursday. On Wednesday, we had our first of our big three hurdles. That was the Consumer Price Index. This is the most widely recognized measure of inflation. Not my favorite measure of inflation, and allegedly not the Fed's favorite measure either, because of the weight that it puts on owner's equivalent of rent or on shelter inflation. It puts a very, very high premium. Over 30% of the entire index is comprised of shelter inflation. And for that reason, if shelter inflation remains sticky, you see a much higher inflation reading than you would otherwise on the other inflation measure called personal consumption expenditures. All that being said, we had a miss to the low side, which is exactly what we want. We want to see inflation coming down. Inflation coming down means interest rates can come down and things can get more affordable. And so we got that. That was great news, 8:30 a.m. Eastern time on Wednesday. Let me flip the screen around here and I'll show you down here at the very bottom. You can see CPI coming in month over month flat. Zero inflation month over month for the entire Consumer Price Index. The yearly figure was up in the mid threes, but that zero against an estimate of 0.1 was great. If you strip out food and energy, we were still below estimates. All of that was excellent, and we saw the bond market rally substantially in the early trading hours on Wednesday. Not to be outdone, and certainly not to have their spotlight stolen, at 2 p.m. Eastern time on the very same day, Wednesday, the Fed released their policy statement. They did not alter the Fed funds rate. No one thought they would. But the tone in the release was very hawkish. They took 2 rate cuts off the table. Their prior Fed meeting, they had stated that they planned on cutting the Fed funds rate 3 times in 2024. By the end of the day on Wednesday of this past week, that had been shaved down to 1 time in 2024. And there was a little bit of confusing dialogue in the press conference held by Chairman Jerome Powell at 2:30. Some of this pointed to, hey, we think the labor market is still really strong, but yes, we're also seeing some softening in the labor market. So some of the dialogue there, it's been described as confused and confusing. And so the markets, gave back some of the gains that we had gotten. Pricing worsened a little bit in the afternoon, and on we went into Thursday, which was the Producer Price Index, where we got more good news, not only showing that inflation didn't grow across the Producer Price Index over the past month, but it actually contracted. We were down minus 0.2% month over month. That's perfect. That's exactly what we want to see. So on the whole, mortgage rates had a decent week. We saw the green is the good direction. That's the direction we want. We saw the bulk of the week. We improved. So we're going to finish out this week in better shape than we started it. And hey, we'll take that. But I do want to call your attention to something called the dot plots. And the Fed meets 8 times per year. In half of those meetings, they release their dot plot projections of where the Fed funds rate will be at the end of this year, at the end of next year, and then, believe it or not, at the end of the following year in 2026. And these dot plot projections are key to understanding the mindset of these voting Fed members and where they think inflation's going and where they think the Fed funds rate is going. Very, very important. So I want to call your attention to the last time we got dot plots, which was March the 20th of this year, just about 90 days ago. And we can see here are the voting Fed members there. And it's tough to see, I'm sure, but I'll talk you through it. So most of these voting Fed members thought, hey, we're going to finish out 2024 around 4 3/4, around 4.75%. For reference, right now, we're at 5.5%. So 4 3/4, calling into question probably about 3 rate cuts, right? That's what we were thinking on March the 20th. At the end of 2025, they thought, hey, more than likely, we're going to be down around maybe 4%, maybe 3 3/4, somewhere in that neighborhood for the Fed funds rate. Fast forward to June the 12th, this past Wednesday, here's what our Fed members had to say. Hey, we're not cutting that much. In fact, it looks like we're probably going to finish out the year above 5% or really close to it with the Fed funds rate. So we see all of this projection that we're going to be down into the high to mid 4s is now stuck around the 5% level. We go out further to the end of 2025, and instead of being 4% or sub 4%, we're now north of 4%. But I want you to pay attention here at the end of 2025. Look at the disparity between the Fed members. We have one Fed member thinking we're going to be hiking rates by the end of 2025. We have another one that thinks we're going to be down at 2 3/4, which would be something like 9 rate cuts over by the end of 2025. So we have a very wide, I would say a little disorganized pattern as we move out into next year. But ultimately what the Fed did is they took a couple of rate cuts off the table. They were very, very hawkish with their comments. The market did not particularly like that, and we saw the market begin to sell off. I do want to talk about the base effect of inflation. And when we start talking about inflation, there's a whole lot of different ways to talk about it. But what the most important way here is month over month. Now, we talk about the big number year over year. We're talking about the last 12 month over month prints added up, right? And where the Fed wants that to be is somewhere around 2% on the personal consumption expenditures. So when you start adding that up, and as we move forward in time, you're dropping off the most or the furthest back 12th month. And what we're getting ready to do as we move into June, you can see here's May, we came in right at 0, right? You can see what we're getting ready to drop off as we move into the next month are these months right here. And these are some really low inflation readings. Listen, if we keep coming in at 0.0%, we're in great shape. Inflation will continue to come down. But if we come in at 0.2, 0.3, 0.4%, we're going to see inflation start to tick back up just because of the base effect, just because of the months that we're dropping off for CPI. So it's going to be a really interesting play over the next 90 days to see what happens with the consumer price index sheerly from the months that we're losing in the overall calculation for the most recent 12 months. Okay, I know that's a lot of technical data, but it's going to be pivotal as we get further through the year, closer to the election, and hopefully closer to some Fed funds rate cuts. In my opinion, the Fed came out way too hawkish based upon the labor data that we've received and based upon the inflation data that we've received. And the closer we get to the election, the less they're going to be likely to cut, which I think leads them into the trap of a potential policy error of continued tightening of very restrictive policy in the face of softening data. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.